Hey everyone, today I want to talk to you about interest rate buy downs. And basically we're just talking about, you use cash up front to buy the interest rate down. And they fall into two basic categories. It can either be a permanent buy down or a temporary buy down. And temporary buy downs are really popular right now for a couple of reasons. If you're a buyer, they can provide, a really nice initial payment relief for the first couple of years that you're into this new mortgage. So let's say you're just growing into this new mortgage, and maybe it's a little bit of a stretch, and that's okay. You can, the house is meant to be a fairly long-term investment. It's supposed to serve you over, multiple phases of life, and it's okay to stretch a little bit, not beyond what you can, what you can comfortably handle, but it's okay to stretch a little bit there. But let's say that you want to ease into that. Well, these temporary buy downs can be a real benefit. And I've got an illustration here that'll walk you through that. And so if you're a buyer, just basically what a temporary buy down is it's just money that's placed into escrow that's used to subsidize your payment for the first couple of years. And so let's just work you through, a real quick calculation. In this case, I'm using, a $550,000 purchase price as an example, 5% down. And let's say the going rate today is 6.830. That's the note rate, and that's what you would get if you were to pay no points, for that. It's a 30-year loan. There's 12 payments per year, and this is what your monthly payment would be. So the way, for example, a 2-1 buy down would work, and a 2-1 buy down is very popular. And what that refers to is, in the first year, the rate is bought down, quote unquote, to 2% below the actual note rate. And then the second year, it's bought down to 1% below the actual note rate. So it's 2 year, you make a payment as if your rate wasn't 6.830, but 4.830 during that first year. So a 2-point reduction in that rate the first year. And then the second year, 5.830. And then, of course, the third year and beyond, you're just paying the actual note rate on the loan. And you can see what that does here. If you have a 6.830, and this is principal and interest only, on a 30-year fixed rate, you're borrowing 5% at $550, your monthly payment's going to be about $34.17. But let's say that instead your rate were 4.830, well, your monthly payment would be about $666 less. So we take 12 months of that, and we put that in an escrow account on your behalf. That gets deposited with the lender, and the lender uses that to subsidize your payment for that first 12 months. And then the second year, we're going to pretend like the rate is really 5.830. And that payment would be $3076 or $341 less. So we multiply that by 12. And we put that in an escrow account. And so you see the total amount that needs to go into the escrow account during that first year is, roughly $12,100. So if you're a buyer, the good thing is you're easing into this payment. Now, of course, you need to be prepared to make this full payment, beginning the very first payment of year 3. So you need to be comfortable that you can do that, but it's a nice relief. And this, if you're a seller, this can be a real nice feature of your listing. Right now it's getting harder to sell homes. They're sitting for longer. There's more inventory for buyers to choose from. Buyers are a little more cautious. And so this can be a fairly inexpensive feature even to write into your listing to say, seller willing to contribute toward a temporary buy down, 2-1 buy down, let's say. Because in this case, let's say that on this $550,000 listing, that the seller commits, and here, in this example, $12,000. That's a fairly modest concession in today's market, what the market is doing right now, and it might be a meaningful incentive. And then again, if you're the buyer, again, this is typically, you're going to do this. The only reason you would do this is because the seller is paying this. You're using seller concession money in order to finance this. You wouldn't just take your own money and give it to the lender and say, hey, could you subsidize my payment for the next couple of years? There's no reason to do that. You can do that on your own. If you want to, play that game with yourself, put that money aside and then use that savings account every month to subsidize your monthly payment, that's great. More power to you. There's no reason to involve the lender. But this is a way that you would use seller concessions, or you would approach a seller and say, I think I can get this property for less than the full listing price, and I'm going to ask for a concession. This is just a great way to do it. So I think it's a win-win. It can help a seller's property be more attractive in a buyer's market that's becoming more crowded, and it can help a buyer ease into it. But here's where it doesn't help. Okay, so this is called a temporary buy down, because you can see it's Year 1, it's 2 points below the rate. Year 2, it's 1 point. And then year 3, you're paying that full rate and beyond. So it's temporarily bought down. And if you want to get really technical, you're not actually buying the rate down because you're still accruing interest at 6.830 the whole time on this loan. It's just that they've advanced deposited some money so that it's as if you were only paying this in terms of your monthly payment stream. But it's temporary. And so one of the things, of course, it goes away. And if you're not comfortable that you'll be able to move into that full payment, you may not be comfortable doing that. You're probably not a good candidate to do that. But the other thing that is equally important is this does nothing for your buying power, right? Temporarily buying the rate down, the lender knows that this is a temporary buy down. The lender knows that you're going to need to be able to qualify for this full payment in a couple of years. And so sometimes, this temporary can be a great thing if there's money on the table that the seller is willing to contribute. It can be a win-win. But there are other options that need to be considered as well, especially if you need to qualify. And let me illustrate that here. Let's say, and this was a real life situation that this is based upon, very recent with me, is that I had a client who could not qualify, wanted to buy, was very interested in a house at 550, more than willing to pay that rate, but couldn't qualify. Basically, debt to income ratios were too high to pay the 550. And so what we looked at, we said, okay, at 550, this interest rate, we're not qualifying, 5% down in this example. This is, I'm willing to pay this, but I can't qualify this. What this buyer needed in order to qualify was a price reduction of $45,000. If the price were $505,000, well, then my buyer could qualify, again at 6.830. But seller wasn't willing to go down that far. Seller had already come down, so wasn't willing to go down that far. And so what we came up with, and this is really where a permanent rate buy down really makes a lot of sense. You can take that same seller concession. So in the other, in the example before, here, in this example here, we were going to use roughly $12,082. Well, you can use that same $12,082, and instead of using it to fund a temporary buy down, you can actually pay points to buy the rate down. So in this seller's case, we bought the rate way down by about 5/8 of a point. We were able to offer full price. We asked the seller for a seller contribution. All it took in order to get this buyer qualified, instead of a $45,000 price reduction, with $12,000, we could buy the rate down far enough to qualify at full price. So now my buyer is paying full price with a seller contribution. So of course, the seller is netting less than full price, but his concession here was $12,082 instead of $45. My client's delighted because he gets the house that he was willing to pay $550 for. He just structures it in a way that he uses $12,000 to permanently buy down the rate. And so here in this case, of course, the monthly price reduction or payment reduction was $217 a month, which was all we needed. Now this isn't as sexy as, say, the temporary buy down, but of course it goes on indefinitely. Now I want to add one more comment about paying points to buy down the rate. I'm generally not a fan. Okay, I'm not a fan as an interest rate play to pay points to buy down the rate. Now, that's especially true when rates are high. When rates are high, I think it's reasonable to expect that there's to be an opportunity to refinance, hopefully in the not too distant future. Nobody can guarantee that, but certainly when rates are higher, there's a reasonable hope that maybe we can refinance this. And points, when you're paying points, lenders price those points to buy down the rate like finance companies price extended car warranties. That finance company doesn't know if they're going to make money on you or not, but they do know they're going to make money on the averages, right? They're going to make money on the averages. They keep those numbers, they track them very carefully, and they price their products accordingly. And so you're betting against the average when you do that. Now, you may be more than willing to do that for the peace of mind associated with having an extended car warranty, or in this case, you're betting against the average that you're going to be in this loan long enough for that cost that you pay to buy the rate down to pay off, because it takes time, right? You're paying to buy the rate down, and then year over year you're earning back what you paid up front based upon that lower interest rate. And generally it's going to take 4 to 5 years, and the average life of loan is right around that period of time. So I'm generally not a fan of paying points, and I'm especially not a fan when rates are high. It's one thing to pay points to buy the rate when they're at historic lows, right? So if rates are at 2.5 and you're buying a long-term house and you want to pay points to get it down to 2%, well, there's not nearly as much of a likelihood that you're going to be refinancing that loan in the near future. than if your rates have been in the high 2s and now they're in the 7s. There's a much greater likelihood. So I'm generally not a fan of paying points, which is the same as a permanent buy down. But in this case, that wasn't why we're not paying points as an interest rate play. We're paying points to get a house that we're more than willing to really believe is worth $550. We're willing to pay $550, but we just don't qualify. So instead of structuring this loan as, structuring this as a $550 purchase with the going market rate, we structure it as a $550 with a $12,000 seller contribution. We spend $12,000 on points and we qualify. So there you go. I hope that helps. If you like this video, please subscribe to my channel. I hope to put a lot more like that up there. Thanks again.